Good evening, everyone. Time for another silver update. This is the big picture again. As I've said many times, you can see we're approaching a very important point here. We could get the drop off straight down when we match up to this point, or we could take off to the upside. Either one is very possible, but as I'll show in this video, this is an incredible buying opportunity because the gigantic paper Ponzi scheme that they are building is destined to collapse. There's absolutely no way that the system that they have built, which is a system fueled by printed money, which comes from the Federal Reserve with nearly 0% interest rates for the purpose of funding an unsustainable government that's out of control, causing the Fed to print $1 trillion of extra money just for the deficit every year, and that money is finding its way into the stock market. The stock market is soaring through the stratosphere, and it is going parabolic. I'm going to show you that when we look at the transports. And of course, the underlying economy is absolutely withering away beneath it. So we are coming to a major inflection point, and it's going to be big when it happens. Now let's jump over to this Jim Quinn, another great one from Jim Quinn from the Burning Platform. He is amazing. This is called the Death Rattle, and he goes into the problems in the retail sector. He connects them with what's going on with the demographic changes here. So let's read some of this, and then I want to compare the information here with what we're seeing in the stock market. Retail store results for the first quarter of 2014 have been rolling in over the last week. It seems the hideous government reported retail sales results over the last 6 months are being confirmed by the dying bricks and mortar mega chains. In case you missed the corporate mainstream media not reporting the facts and doing their usual positive spin, here are the absolute dreadful headlines. Walmart profit plunges by $220 million. Target profit plunges by $80 million. Sears loses $358 million in the first quarter. JCPenney thrilled with a loss of only $358 million for the first quarter. Kohl's operating income plunges by 17%. Costco profit declines by $84 million. Staples profit plunges by 44% as sales collapse, closing hundreds of stores. Gap income drops 22%. American Eagle profits tumble 86%. Will close 150 stores, etc., etc., and it goes on. Of course, those headlines were never reported. I went to each earnings report and gathered the info that should have been reported by the CNBC bimbos and hacks. Anything you heard surely had a Wall Street spin attached, like the standard better than expected. I love that one. At the start of the quarter, the Wall Street shysters post earnings expectations. As the quarter progresses, the company whispers the bad news to Wall Street and the earnings expectations are lowered. Then the company beats the lowered earning expectation by a penny, and the Wall Street scum hail it as a great achievement. Yes, that's absolutely correct. I've been talking about that for at least 10 years. That is the gigantic Wall Street scam, their earnings beat by a penny. It's kind of like, it reminds me of the way the Congress works when you have votes that where bills are passed by one vote. And you used to see that all the time. And of course, what goes on behind the scenes is that these corrupt politicians, they already know what they're going to do. So what they're doing is they're bargaining for votes. You vote for this. If I vote against that, I'll vote against this. If you vote against that, well, we can't made to be seen to be voting for this, blah, 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 blah. So they're trading votes, and they're not representing their constituents at all. And that's how you end up with a rigged vote that passes by one vote. Same thing with these earnings. You get a beat by 1 cent because, of course, it's all just contrived. The Muppets must be sacrificed to sustain the Wall Street bonus pool. Wall Street investment bank geniuses rated JCPenney a buy from $85 per share in 2007 all the way down to $5 a share in 2013. And again, That's something I've harped on for 10 years as well, that the buy ratings on those, first of all, when you look at these companies, you virtually never see a sell rating. In fact, the only time you ever see a sell rating is when the company's gone bankrupt or near bankrupt, and then they just throw in the towel and issue a sell rating. That's after the horse is out of the barn and the stock is down 95%, and they go ahead and issue the sell rating. Wouldn't it be nice if they'd issue a sell rating at the top? So I'll go ahead and issue some sell ratings here when I cover the constituents of the Dow transports. No more needs to be said about Wall Street analysis. It seems even the lowered expectation scam hasn't worked this time. U.S. retailer profits have missed lowered expectations by the most in 13 years. They generally beat expectations by 3% when the game is being played properly. They've missed expectations in the first quarter by 3.2%, the worst miss since the fourth quarter of 2000. And then he goes on and talks about how these declines in retail are going to impact the real estate market. Eventually, those stores are going to be closed. The pundits, politicians, and delusional retail CEOs continue to await the revival of retail sales as if reality doesn't exist. The 1 million retail stores, 109,000 shopping centers, and nearly 15 billion square feet of retail space for an aging, increasingly impoverished, and savings-poor populace might be a tad too much and will require a slight downsizing, say 3 or 4 billion square feet. Now think about that. Now he has an amazing chart here, and I've never seen this statistic before, but this is retail square feet per person. And you can see that this is not just retail square feet. So don't get confused on that. It's not just the amount of retail space that's out there. This is square feet per person. And you can see the chart here from 1960. It's gone from 4 to 38. There's 47, actually now we're at 47. There's 47 square feet of retail space per person in America. This is 8 times as much as any other country on earth. This is up from 38 square feet in 2005, 30 square feet in 2000, 19 square feet in 1990, and 4 square feet in 1960. If we just revert to 2005 levels, 3 billion square feet would need to go dark. Unbelievable. And he goes into the demographics of how the population is aging and the spending by that group of people is obviously declining and is going to decline some more. He talks about the lack of retirement savings and the savings rate. He talks about the decline in household income and, of course, the off-cited labor participation rate and people's equity in their houses. And then he talks about the Keynesian nitwits in government. And this is a very good summation of it here. The entire engineered recovery since 2009 has been nothing but a Federal Reserve U.S. Treasury conceived debt manufactured scam. These highly educated lackeys for the establishment have been tasked with keeping the U.S. Titanic afloat until the oligarchs can safely depart on the lifeboats and all the ship's jewels safely stowed in their pockets. There has been no housing recovery. There has been no jobs recovery. There has been no auto sales recovery. And that's one that gets me. That one is hilarious. I don't know if you saw the pictures of lots of unsold cars. Now, some of that was debunked because it goes back many, many years, but there are a tremendous number of unsold new cars. Of course, they're not going to lower the price on them. They're just going to probably let them rot. And then we have the recalls going on at GM. I just can't believe that anybody in their right mind would buy a car from the government. Of course, now it's not the government, so they spun it off. It's going to go bankrupt again. Giving a vehicle to someone with a 580 credit score with a 0% 7-year loan is not a sale. It's a repossession in waiting. The government-supplied student loans are going to functional illiterates who are majoring in texting, Facebooking, and Twittering. Do you think these indebted University of Phoenix dropouts living in their parents' basement are going to spur a housing and retail sales recovery? The Keynesian solution was designed to produce the appearance of recovery, convince the masses to resume their debt-based consumption, and add more treasure into the vaults of the Wall Street banks. The master plan has failed miserably in reviving the economy, savings, capital investment, and debt reduction, which are the necessary ingredients for sustained, healthy economic system. And he goes on. So those are the fundamental facts about the economy. I agree with everything he says there. Now I want to take you over to the transports index. Let's go ahead and look at the chart here first. So again, here's the silver chart, done absolutely nothing because we know that the Federal Reserve doesn't want any money to go here. So they manipulate this market with derivatives and corrupt regulators who don't allow for a free market trade. It's all paper trading. We know this is a fake market. Now let's look at the Dow transportation, because we've been looking at the Dow 30, the industrial average, a lot, but the transportation index is even more startling when we look at this index. When I first looked at this, I simply couldn't believe my eyes. This is the breakout that we're on here. You can see we're just ready to take out 8,000 on the Dow transports. In fact, if we go into the 1 minute, you can see that it touched up to 7996 basically. But let's pull out to the weekly and take a look at this. This is the Dow transports. Now you can see this is from 2009 here. This was the beginning of the major massive money printing that they did. And there is the rate. So you can see we're talking about 2,200 all the way up to about 8,000. So we're already nearing a fourfold return since the beginning of quote unquote recovery. But when we pull out to the week or the monthly, I'm sorry, you can see when we pull out to the monthly, this doesn't show it as well as the Yahoo one, which is what we're going to go to next. I don't think it goes back far enough, but it is absolutely startling. So let's go and pull up the Yahoo chart. I started with the components, so let's look at the average itself here. So this is the max chart of the Dow transports. So let's point out a couple of things here. Here's the 1987 crash. Think we're headed for a crash? Here's the NASDAQ crash. And here's the last economic downturn. And this is where we are right now. So if you believe, as I believe, that parabolic moves always end in a crash, then we are in the middle of that parabolic move. Now let me take you back to the components here, because when you look at the components, you're going to be absolutely shocked. Now I've already covered the fact that Wall Street rigs the indices, and you can't trust anything that they say when it comes to what the index is, because what happens is the index drops people in and out all the time. They're constantly adding and removing certain companies from the index, and what happens is they rejigger the number so that they can always keep a positive return on it, always keep a positive number. For example, once I come back up here, I'm going to show you the members of the transports, and those have changed over the years. And so they put the winners in there. For example, in the airlines, you have Alaska Air, and you have Southwest Airlines. but you don't see American Airlines, and a lot of those went under or were reestablished, bankruptcy, and reorganized, etc. So these things are constantly being rejiggered. You have to remember that, and the purpose behind that, of course, is to keep them rising. But I wanted to just pull these up so that you can look at some of these charts. This will start out with Alaska Airlines. This is the max chart on Alaska Airlines. You think we're in a bubble? Look at that chart. Have you ever seen anything like that? Look at the chart from the dot-com era and what happened in the financial downturn of 2008. You can see we went from 20 down to about 8. So where are we going this time? From 100 down to about 20 or 10? Crazy. And that's not the only one. Let's look at some of the railroads here. Let's look at Norfolk Southern. Is that a chart that's going to crash? Again, here's .com, here's the last financial crisis, and here we are right now. Let's look at another railroad, Union Pacific. Now remember, these are the components. These are the ones that make up the indices. $196 a share for Union Pacific Corporation, and you can see, look at that chart. Look at the last downturn. It pales in comparison. Look at the .com downturn, or look at the 87 crash. You can't even see it. It doesn't even register on this chart. That's what kind of a bubble we're in. This is going to end in a catastrophe. This is going to be a catastrophic crash when this thing goes. So you have retail sales being hollowed out. You have the Federal Reserve printing money hand over fist, claiming that they're going to taper, yet keeping 0% interest rates, and having mysterious buyers from Belgium as the demographics begin to decay and people who are getting older than 65, they're not buying anything anymore. So what's going to happen? What's going to happen is this thing is going to crash. And when it does crash, I don't know if the trigger is going to be them raising interest rates. I don't really know what the trigger is going to be. What this represents is a giant Ponzi bubble where all the people are gambling with the money that the Fed has printed, the banks especially, and the 1% or the 0.1% or whatever you want to call them. They're gambling with all this paper wealth, trying to make more money in price appreciation, and they're creating the biggest bubble in the history of the world. And when this thing crashes, it is going to be the biggest crash in the history of the world. It is going to be an absolutely catastrophic crash. And hopefully when that happens, you're holding physical gold and silver. And we'll talk to you next time.